Hello, this web video is going to go over the basics of the JSStock's market structure and show how you can incorporate it as part of your daily routine to improve your awareness of the current technical condition and identify opportunity. You should have both a monthly structure overview as well as a daily structure overview. The daily and monthly structure are similar, but the daily does include both the R level for the weekly and the monthly. The goal of the analytics is to condense a large amount of information into an easy to read price map structure. To get started, first thing we want to focus on is the monthly analytics, and we're going to look at the R level, which is highlighted in green at both the top of the structure as well as on the grid. We're also going to look at the critical range, which is defined by the UP upside pivot in red and the DP downside pivot in blue. The R level is a sentiment bias level. It's basically the over-under number for the period. So for the monthly, it's going to define sentiments for the month. For the daily, it'll define it for the day. Literally, it's a line on the chart, and above that price, mark it as positive sentiment, and below that price, mark it as negative sentiment. This is the best risk-defined area on the price map structure, where risk is the least and opportunity is the greatest. I recommend that you plot the monthly R level on a daily chart to get a sense of where sentiment is. You can also use the daily structure and plot the weekly and the daily R levels on the chart, and then just manually adjust the daily each day and the weekly once a week. This view helps to identify the technical condition. So currently for the daily, we have positive sentiment above the 282.81 daily R level. That's in line with the weekly sentiment above 269.75 in the IBB. And both the daily and the weekly positive sentiment is going against the monthly negative sentiment, which is defined at 305.86. So we're basically in more of a corrective state at the moment for IBB, with short-term positive momentum rallying into long-term negative momentum. This is more of a corrective technical condition. Corrective conditions can be choppy, they can be emotional. It's just part of what it is to be in a corrective condition. But understanding that fact provides better awareness during the trade period. If price action were to break below the daily R level at 282.81, you would have negative sentiment on the daily, positive on the weekly, and negative on the monthly. The market would be more into a neutral situation where it's digesting. If price continued to move lower below the weekly R level, then the market would be back into a negative trend mode. So below 269.97 is where price needs to go to turn all of the sentiment negative and get us back into this big negative momentum. And conversely, for the market to shift sentiment, it would have to rally above the monthly R level at 305.86 to put all the weekly, daily, and monthly sentiment in alignment and put the market into a bull trend. Again, identifying sentiment bias for the daily, the weekly, and the monthly provides clarity to the technical condition. That's the first step to understand the bigger macro picture as you start your day. The next thing we want to focus on is the structure of the market, and we're going to use the critical range to do that. Critical range is a behavioral study, and it identifies the area of indecision or the neutral zone. And there's a midpoint, not necessarily symmetrical, that we call the directional. So the market will rotate around this directional point, trying to find a bias. Above the directional, the market's going to lean positive, trying to make a play for the upside pivot. Below it, negative, making a play for the downside pivot. And when we get a breakout of this range, it signals a trend move. And we give targets. Upside target 1, upside target 2, the downside target 1, downside target 2. And you can see that over here identified on the structure sheet. In a general sense, a breakout of the critical range, the objective is the second target. We call each one of these segments an average price map distance, and we're looking for 2 average price map distances, or 2 APMD move. So you can base your risk off of 1 APMD up to the first target, but the second target is the objective. Third target would be a best case, and fourth target would be for an event. We also offer extremes that is highlighted in aqua to the upside and pink, bright pink, to the downside. So as the market moves above the upside pivot, it's more optimistic, you're in a bull trend mode in a general sense, and as we move beyond the third target, we're getting into an extreme situation or a euphoric situation. And on the downside, you're more pessimistic, you're in a bear trend situation, and you have more of a panic or an extreme as you move beyond the third segment. This is just the general structure of how this critical range expands on itself. And we're going to be identifying where the last traded price is within this structure to get more clarity to the current technical condition. So I have a daily chart here. I have my weekly, my daily, and my monthly R levels, and now I've put the monthly price map structure on it. The critical range with the upside pivot at 278.51 and the downside pivot at 242.03. And here I've identified the midpoint, the directional. Here's the monthly structure that is marked off by the start of the month. During this time, the market has broken out of the critical range to the upside. So we have that awareness that the market is breaking out. We're in a breakout mode. Where can it target? Well, it can target the R level. If not, the UT2, which is at 314.98. The critical range has some unique structure to it and identifies the price segment distance the market is trading in. We have some interior levels. We call it the critical range negative and the critical range positive, and we also have the critical range extreme positive and extreme negative. The market does have certain behavior when it's trading within this critical range, and sometimes you'll notice the market's rotating within the CR plus and CR minus. That kind of signals more of a digestive trade expectation. When the market breaches the CR plus or CR minus, it gives a transitional signal that the market is looking to rotate to the upper extreme or lower extreme. Outside the critical range, we have the CRX plus and minus, and these are good extremes for a false breakout. So sometimes the market will flush through this key market structure point at the upside pivot, but it will not be able to breach the CRX plus, and that's a tell that the market has gone to an extreme and is exhausted. And also on the breakout of the upside pivot of the critical range, a good confirmation is that the market takes out the CR plus, and that's a tell that the market wants to move higher. Doesn't mean it's going to immediately go. Sometimes you'll see a pullback even all the way down to the CR plus, but the fact that it violated the CRX plus is a tell that the market wants to trend higher. So I've added this monthly structure to this daily chart, and we can see that the market has confirmed this breakout at the CRX plus. You can see at the beginning of the month the market did break out of the critical range and stalled out at the CRX plus at that exhaustive, and then gave us a pullback down to the CR plus. Also interesting to note that how the weekly is in confluence right now with the CR plus. We're going to look at price action within this market structure to get better clarity. And at the moment we have a market that is confirming this upside breakout above the CRX plus. Again, it's all about finding clarity, watching price action within the market structure. The next thing we want to do is to look at the daily structure. So I've pulled up a shorter term time chart, a 10-minute chart, and I've plotted the daily critical range as well as the daily R level. Again, and we're watching how is price action working within this market structure, and we can see that the market is trading dead center to the directional. You can also see that the recent pullback stabilized above our R level, so this is going to be our big support level, and sentiment is positive above here on the daily. When we view the daily structure with the monthly structure, we get added clarity. I've put the monthly CRX plus on the daily, and we can see how important this directional area on the daily truly is. Because if the market is going to break out, it should maintain a trade above the monthly CRX plus, and that would be the same for the directional, where we'd want to see the market maintain a trade above the daily directional, signaling a play for at least the upside pivot on the daily, if not a play for the monthly R level. These market structure points have a variance around them, or a microstructure, and we call them our market metrics. The main ones are the variance and the alert distance. The variance is really the optimal area around the inflection point to enter the market, and the alert distance identifies the zone for signal acceptance. You can also use it as a trigger for, is the market through this level? Has it violated the level? The alert distance will tell you that. Here I'm showing three different entry strategies. One is a fade. So if we're going to look to fade momentum, we can use the metrics that we want to have. First conditional alert would be to have the market starting above the alert distance, and then we can look to start entering at the top of the alert distance down into the variance. A breakout, we'd want ideally to see the market start on the opposite alert distance, confirm a breakout through that alert distance, and then we can look to enter the alert distance in the variance, anticipating the breakout to follow through. And an exhaustive reversal, where you have the market start out above the alert distance, go below it, and then come back above through it. That makes the reversal statement true, and then we can look to enter off the alert distance or the variance. These metrics can be found at the bottom of the sheet. We also have that average price map distance. That defines the price segment moves the market's trading in. And this is the daily analytics. And we have the average price map distance at $3.80. The market's trading in $3.80 segments. So we're going to look for half of that on trades, a full APMD, and two APMDs. Those are kind of the standard metrics to look for opportunity. Then we have our variance at 30 cents, alert distance at 53 cents, and I've also added a maximum stop distance at $1.68. So that would be the maximum amount that you'd want to risk on any opportunity in this market. I've put the alert distance metrics on the daily structure because it's important. We're looking for a breakout, the market coming from below the directional, and we want to see it breach that alert distance, and then we're going to look to enter off the variance or at the alert distance. So we need the market to price qualify above 288.74, which is basically the alert distance plus the directional. So we're always looking for price structure within market structure, and so price structure, a positive impulse is higher move highs, higher move lows, basis price, or a negative structure, lower move lows, lower move highs. That determines a trend. So if the market's going to make a trend move, it's going to hold positive or negative price structure. If we see a break in that structure, that's a tell that the market is dropping back into more of a digestive trade. Maybe it's for an hour, maybe it's for 3 days. Depends on what structure you're looking at. But it's a tap on the brakes to the trend. If we get a second structure break, that's confirming that this trend is no longer true, and we might be either in transition into a new negative trend situation, or maybe just into a digestive trading environment. Just as we're watching price action, we're watching it within market structure. So we're going to look for that price action to hold positive structure, but we're also going to look for the market to hold positive or negative market structure, which is basically climbing the price map ladder, climbing the structure ladder. So as the market takes out a structure point, it should maintain a trade above it and continue to maintain a trade above it as it works its way higher. If we get a failure after we've taken out a market structure point, that's like a tap on the brakes, just like a price structure break. And if we get a second structure break, that would confirm that that market structure has been broken. So just looking at the monthly, since we have a little historical here on the monthly. So right at the start of the quarter, the market makes a move from the directional and gives a breakout signal at the directional, targeting the upside pivot. Market breaks out of the upside pivot, stalls out. Here we get a break in market structure, but it's more of a tap on the brakes because we hold the second structure point. This sets up this digestive action, and we can see the market stabilizing above this major structure point, the upside pivot. So this is a sign of strength. We're consolidating above this level, so what once was resistance is now support. And then here we're getting a confirmation breakout. So now the underlying positive momentum is engaging, and we're going to watch positive price structure and the market making higher move lows and higher move highs. And we're just going to work that higher move low, higher move high structure. We can also use that on the daily. And so here on the daily, if we do get a breach and confirm for the session that the market is breaking out above the directional, it should maintain these small impulses. It should maintain higher positive structure. And if it doesn't, that'll be the tell that the market may fall back into a digestive trade or for a retest of this support area. Because this is really where the liquidity is. The real buying energy is down here below the market. So if the market's going to go, it should just go. Since we have the awareness where we are at on the bigger picture, we can see that this should just open up and we should just have a really strong surge, which could target the 296.74 upside target 1 on the monthly, and that comes into alignment with the upside target number 1 on the daily at 296.11. And we can use our metrics. So we have a 2.55 cent alert distance around this area, so that comes into play here. So that can give us confidence that if this market does start to make a move, it could take out the upside pivot and just continue higher up to this area here. So to start out simply and understand the dynamics between the daily, weekly, and monthly sentiment bias, this will give you clarity to the condition. Note the long-term structure to have clarity to where in that structure the current price is. Are we inside the critical range? Are we above the directional? Are we below the directional? Or are we outside the critical range? Know where you are on the full price map structure, and then look for confluence of daily and weekly R levels and the monthly structure. These are going to be the real value areas when you have the weekly R level in alignment with the CR plus on the monthly. And you can do the same thing with the dailies, just to get a sense. Here's the bigger picture. Here we are at the moment. How does this smaller structure work within the bigger structure? And we can see that the market really needs to hold these levels and should just go. And if it doesn't, we could easily fall back into a digestive trade. And so here we have our daily R level coming in at 282.81, which is really in the middle. It's not very interesting. And the bigger support on the longer term is down here at 278.51. And that comes into alignment with our downside target number 2 at 277.10, plus or minus this alert distance. And so if we did get a failure here, where could it go? Well, we could actually correct and get a trigger here down to this area here. And if we did have a failure here, that would be 2 APMDs down to the DT1, which would put us back on top of this support area here. Kind of putting the market back into a little bit of a digestive trade, with this R level being the pivotal point to the bull trend is going to re-engage, or we're going to have a sideways digest. So as a review, to prep at the start of every month, plot the monthly structure with the daily and weekly R levels. Every start of the week, you can adjust the weekly R level, and daily, adjust the daily R level. Then you have your foundation structure on an image on a chart. And then in your routine, you want to identify the condition. What's the relationship between the monthly, weekly, and daily R levels? And then identify the opportunity. What is the potential that one of these R levels will be in play for the day? For the critical range, it's going to identify the areas of opportunities. Where do the daily and monthly levels match up? And what are the market metrics surrounding each level? During the trading session, you simply want to monitor price structure within market structure in the context of the underlying technical condition. How does that match up with all the fundamentals and events that are happening in the trade period? For more questions, please contact me at js@jsservices.com. Thank you.